Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. We are hunting for value and we are looking at various companies. The company on our radar is Shriram City Union. After a weak fourth quarter, the management had guided for some improvement in asset quality and a possibility of gross NPAs coming down from 9% to 8% in FY19. V. Lakshmi Narasimhan, the Executive Director and Head Investor Relations, Shriram City Union, has joined us now. Mr. Narasimhan, thank you very much for joining us. Well, first up, we've seen almost 90% of the April, May, June quarter. What has been the trend? Are you looking at any improvement, more people returning, defaulters returning their loans, or at least a fall in the growth of defaults?
Yeah, good morning, Lata. What we have seen thus far in this quarter is pretty encouraging. We kind of guided for a growth of between 18 and 20% for this financial year. So when I say growth, we are looking at SME being the driver product. That's close to 56% of the loan book. We've seen growth come in three products during this quarter: SME, two-wheeler, and the personal loan segment. The gold is something that we are still working on. We have not seen growth in that product yet. But I think what we have guided, we should be able to get to the year, at least during the first quarter. It looks pretty encouraging.
So when you say that you're going to see growth in these three segments, can you just break it up for us? Because in the two-wheeler segment, in the last quarter, you saw 44% growth. SME saw almost a 30% growth. Personal loans was up 45%. Do you think you can better these growth rates in the quarters to come?
I think on a whole year basis, if gold is not going to grow and my auto product is pretty small, so I'm not looking at too much of a growth in that, then the three products that we just now mentioned in terms of SME, two-wheeler and PL needs to grow better than what it did last year. So I think personal loan will have a disproportionate growth than last year, essentially because we put a cross-sell model in place. Two-wheeler will largely map the industry. So if the industry is growing at about 10, I should grow about 22, 23. And SME, the question is how quickly we get our mapping done of the non-south locations, which is essentially north and some parts of west. So the business is there for us to take, at least in that segment, for the segment of customers that we operate in. So I think we should get better than what we did last year in terms of the individual products. But on an overall basis, I would sincerely suggest that we stick to our 18 to 20% growth plan.
Okay, 18 to 20% overall loan growth plan. What is the expectation in terms of margins now that wholesale money is a little expensive?
Yeah, things have gotten tighter right from March. We are seeing that wholesale money obviously has gotten tighter. I think the price has also gone up. We had looked for an overall increase in cost of fund about 10-15 basis points for the whole year, considering close to 50% of my borrowing as of March 18 was on a fixed rate basis. So those don't come up for revision. But I think that 15 basis points will get tested. And we are now looking at anything between 20 and 25 basis points increase in the cost of fund for the full year.
Okay. I wanted to talk a little bit about how subdued the demand for gold loans has become. I mean, it's an across the industry phenomenon that we're seeing. You think it's just an aberration, just a 1-2 quarter phenomenon, or do you think that now there is a big change, people are now shifting to personal loans from gold loans, and that's something that you can expect to see for a long time?
Yeah, I think gold loan seems to be pretty structural because this is not the first quarter or first year where we have seen a degrowth. We've been seeing that now for the last 3 odd years. I think it's a mix of two things: the regulatory side of it, because there was a lot of uncertainty in the last 3 years, some rule coming in, some changing, so on and so forth, and of course the preference of customers to shift to the more easier personal loan segment. I think it's a combination of both these that we are seeing this. Having said that, in the limited network that we have, because we are present in 5 states for the gold loan business, and in these 5 states, we need to get our strategy right to be able to grow the gold loan business, and that's what we are working on, and that's what we guided at the beginning of the year as well. So it's structural as well. It's not that it's not that gold loan is something very individual to me. I think it's structural in terms of the changes in the last 3 years.
Okay, so very quickly, if you can give me some numbers on margins, what is the average cost of money likely to be for you in FY19? How much can you pass up, and therefore what may be a ballpark margin?
I think we ended last year at a gross yield of 20.1% with a cost of fund of 8.9. We have guided for an overall drop in margins of anything between 50 and 60 basis points for this financial year.
Okay.
So I think a combination of both increase in cost of fund by 20 basis points and a drop in yield should take us to about 19.5, 19.6 for the full year in terms of gross yields.
Okay, that doesn't look too bad at all. Mr. Lakshmi Narasimhan, pleasure speaking with you. Thank you very much for giving us an idea of how the current quarter has panned out. Looks like it should be an improvement in several verticals in terms of total loan growth and maybe a reduction in NPLs, but a slight drop in margins. Well, with that, let's get back to the Ambit India Access Conference that's underway in London. Ahead of the conference, we are being joined by Ashok Wadhwa, the Group CEO. Good morning, Mr. Wadhwa. Thank you very much for joining us. Well, first up, what is the view that you are getting on Indian equities post the recent underperformance vis-a-vis several global markets?
You know, I guess we are in that time of the political runway where we have to brace with volatility. Given that elections are now less than 12 months away in India, it's not an unusual situation. I think we have, I would say, a different and a bigger challenge this time, which is what's happening around the globe. If you look at, in some sort of sense, the trade war that's going on between the US and China, I think it's leading the way for the markets to remain volatile. So I would say that Indian equities at this point of time are affected partly by the fact that we are getting into political space, being election 12 months from now, and partly for what's happening around the world. Having said that, we also need to acknowledge that the macro factors over the last 6 to 12 months in particular have not been favorable to India, whether it's oil price or the resultant current account deficit, inflation, impact on currency, are all factors that are showing that Indian equities will remain volatile for a period of time. Having said all this, I think the micros are starting to look up. Clearly, led by demand, there is greater capacity utilization. And for the first time, I'm actually hearing Indian promoters talk about increase in capacity and therefore private investment. So macros, I would say, are not in favor of Indian markets. Micros seem to be positively inclined. And overall, the market will remain volatile, but within a range.
Okay, volatile within a range. Ashok, good morning. How's the mood amongst global investors, towards India? I mean, has it improved at all versus what we've seen over the last 6 months?
On the consumption side, investors continue to be bullish. And as I stated earlier, because of greater capacity utilization, people are starting to talk about additional capacity and therefore new private sector investment. What we're still not hearing is new investments, new projects, and in particular, private sector investment in infrastructure. We are aware that the government has a huge investment program for infrastructure projects. But honestly, until the private sector recognizes that the opportunity is here and for real, this opportunity, the larger opportunity on investment in infrastructure, will remain muted. We've also got some banks that are present here, both public sector banks as well as private sector banks. And I still see an element of tentativeness and nervousness in public sector institutions looking at financing private sector for infrastructure projects. I guess they're all facing the pressure of current NPAs and how to deal with them. And to that extent, the fact that the IBC resolutions have not happened as fast as possible has also meant that any reversal that was expected by these banks in their provisions, or indeed an expeditious settlement of locked assets, seems a little delayed. And I guess that all contributes to the banks feeling a little reluctant at this point of time to make large commitments, in particular to private sector and infrastructure.
Okay, Mr. Wadhwa, you know, trade war fears are back on the table, especially globally, of course. How are the investors you are meeting reacting to this?
Well, I guess the early morning tweet every day from either the West or the East is determining the sentiment of the market in lighter vein. No, but clearly, people recognize that we are probably in a protectionist era. And so long as this protectionist attitude continues to prevail in the larger economies, countries like India will have to be ultra sensitive and cautious. Our industries that are largely export dependent will remain nervous, will remain tentative, and I can see why the markets continue to be a little negative on these stocks. This morning, for example, US President's tweet and application of duties on motor vehicles, which may or may not have been meant for India, has meant that stocks like Tata Motors and Ashok Leyland are feeling the pressure today. So I would say that for present, it's day by day, and for present, depending on what the mood in the morning or which particular product is being identified as subject matter of extra duty, the markets will react to it on a day-to-day basis and product-to-product basis and company-to-company basis.
Okay. You know, GST is now completing 1 year, this whole rollout, etc. Are you satisfied with what has happened so far?
Listen, a significant change like GST is bound to create turmoil anywhere in the world. I do not know of a single jurisdiction that has been able to implement such a significant change without some element of chaos. I think government's ability, desire and flexibility to continue monitoring pain points, to continue addressing pain points, to continue listening to what both the regulatory agencies as well as the business institutions are telling them and react to that very positively, have all helped smoothen the curve over the last 12 months. Having said that, does it mean that from here onwards we can expect maximum collection and full buoyancy and least amount of pain? An important change like this takes 2 to 3 years to settle. And whereas the initial part of the pain has been addressed, some new pain points will continue arising. But again, I'm positive and bullish that if the government continues to react in the positive manner that it has, addressing issues as they arise and not really waiting for a point of time, you will continue resolving more and more issues, and over a 2-year period, you should be able to achieve what we set out to achieve: a more simpler regime, simplicity in tax, avoid multiplicity, and hopefully all this leads to a significantly larger tax collection. And that's the important point. India's tax to GDP ratio must improve from the 12-13% to 17-18%. And I hope and pray that GST is able to contribute significantly to that process.
Mr. Wadhwa, completely out of time. Thank you very much for joining us and have a great conference out there. We are winding up on Bazaar with the big indices, Sensex and Nifty absolutely flat, but a bit of pain on the mid 2:1. So a lot of short and long ideas coming up for you on Chartbusters.